Welcome everybody to today's video podcast. I'm joined with Chris Carlin from Master Your Money Now. Chris, thank you for being here.
Thank you for inviting me back. Great to see you again.
Yeah. Okay, Chris, can you just give us a little intro? Tell us a little bit about yourself, your background, what you do before we kick off our conversation today about refinancing.
Yeah, so I'm a financial planner and mortgage broker at Master Your Money Now, which has just moved into the Vista Financial Group. We're based down in Geelong, but we look after clients all over Australia. We specialise in millennials, especially millennial nurses and teachers, which is quite unique in the financial planning space that our average client age is 34. So really understand what millennials are going through, especially everyday millennials are going through when it comes to buying their first home, protecting their loved ones, and investing so they can retire early and with more. So, we work through all the various tips and traps associated with that and set up some really good foundations so they get their money working smarter and harder and get the benefits both in the short and long term.
Amazing. So today we want to talk about refinancing. So
Yes.
there's a lot going on in refinancing
Yep.
in the mortgage market.
Mm.
Interest rates have been rising for a long period of time. And I want to kick off by getting your thoughts on what do you think is going to happen next? I know we had a rate freeze last month,
Yep.
the RBA's last decision, but what's next, do you think?
Yeah, great question. Let me just get my crystal ball out to answer this one. So look, I am 50-50 at this point that we're at the top of interest rates, at the top of the interest rate cycle. We're seeing inflation is coming down, which is good, and we're also seeing that also in the US it's starting to come down a little bit. It's still high, but it's starting to come down. So I think that's a good thing. Also, we've got to remember it's something like 30% of all loans in Australia are coming off a fixed term within the next 6 months. So that means there's going to be a lot of people. We've got a few clients that are going to go from 2.5% to 5.5%. An extra for a single nurse, 500 grand mortgage. That's an extra 15 grand a year that they've got to find to be able to keep their house. So that sucks for them. But in a bigger picture, it does mean that it's going to be less that they're going to spend on other things, which means inflation is going to come down. So little bit nerdy information there, but I said, I do believe that, I said there might be one or two more, I think it is likely that we're at the top. And I still believe, I've said this since the start of the year, that I still think there will be a rate cut before the end of the year. So, and there's a lot of talk. Westpac came out recently and said there's going to be 7 rate cuts in 2024 and 2025. So if you are struggling with a high rate at the moment, we are coming off the fixed interest rate term. Yep, it's going to be tough, but the signs are looking good that things are going to get better from an interest rate perspective over the next year or two. So just hang in there and get through this tricky path, because in the next 12 months, I think the situation's going to turn in a bit more in your favor and interest rates are going to come down. But life is fickle. We don't know really what's coming next. Let's see what happens.
Great answer. I'm going to hold you to that. The rate cuts in there.
It's an idea. Don't hold me to that. Okay.
Okay. So let's talk about that then. So you mentioned an example of a client who's rolling off a fixed rate, 2% going to 5.5%, nearly 6%, or closer to 6%. So that's a big hike. And we're talking about several $1,000s per year. That's a common scenario that a lot of people have already faced this year.
Yep.
And that will continue to face. So in that case, we've got your tried and trusted method of going through your expenses, looking at how you can meet that additional repayment figure by looking at where else you can recover some other additional money from, by cutting expenses elsewhere. But the next thing, there's only so much cost cutting everyone can do. So the next thing naturally everyone starts to consider is, well, I'm gonna go out to market. I'm gonna look at refinancing. But there are some difficulties when you're refinancing in an environment where rates are continually rising. In the last 12 months, it's been a monthly occurrence. So what are some of the challenges that people will face refinancing in a rising interest rate environment?
Yeah, good question. In terms of the challenges that people will face, I think we've got to appreciate, particularly in terms of, yeah, we can refinance, that's all good, but your borrowing capacity is significantly reduced over the last 1 to 2 years. So, and already seen a lot of clients who say, even we're working through one at the moment, single person on about 80 grand a year, borrowed 420 for their first home, wants to get a cheaper rate. They're not too bad, but could do a bit better. But now they can only borrow about 380. So they actually can't refinance because of their income doesn't support their existing loan with another lender. So that's certainly one problem you can face. There's also another situation which it's a bit more depends where you live. Down in Melbourne, you'll probably see this a bit more than say somewhere in Queensland is negative equity. So particularly for those who bought under the first home loan deposit scheme and a 5% deposit, or you use lender's mortgage insurance, if your property has dropped from say 600,000 to 550, that's going to make refinancing a lot harder. And so if you don't have that equity, ideally 20% equity in your property to refinance, unfortunately, you are in a situation where you're effectively stuck and must remain within with your existing provider. So they're the two challenges that we're going to be seeing a little bit more of at the moment. Um, and that's where, yeah, there's certainly, if you are in that situation, yeah, it's not great, but there are a couple of things that you can do to try and get the best rate out of your bank. But just have a chat about your options. And like I said, there's about 40, 50 different banks that you consider. Everyone's got different lending policies. Certainly speak to a mortgage broker about your options, and even valuations vary from bank to bank as well. So you've got to take that into consideration as well. So definitely shop around for another opinion, but also it might be worth going back to your current bank to see if you can get a better deal there.
Yeah, and we'll talk about that next. But I just wanted to hit on that point because I think it's a little bit it's a little bit misleading. A lot of the press you see around this fixed rate mortgage cliff, and then a lot of the advertising that comes in from the banks, just headlines the rates and what rates you
Yes.
can get. And so people think, oh, well, there's my option. I'm rolling off 2, going to 6 with my current lender, but these guys are offering 4.7. So there's my solution. But the problem is, as you rightly pointed out, just qualifying through their serviceability tests is the big challenge. So let's assume that, there's not a negative equity situation. Let's say that your property's got some equity in it.
Mhm.
Most people would have, well, this is a question to you, would most people have suffered unless they've had a massive rise in income over that period? Most people have suffered a drop in their borrowing capacity just because of the changes in the way
Uh,
that they
uh,
have it.
yeah, unquestionably so. Yeah, so I'd go back 2 years and say for a single person, no debt, no help, debt or anything that they could borrow, and no kids, they could borrow 6 times their income. That's probably dropped to probably closer to 5, 5.5. So senior nurse, 100 grand a year, could borrow 2 years ago, say 600. Now it's dropped to between 500 and 550. And of course, you've had a situation change, i.e. you bought the bigger family home and now you've got kids. That makes it a bit more challenging as well. So for couples, it might not be as much of an issue if they're still working. And if they're still both working part-time or full-time, but certainly for single people or those who've gone from dual income to single income with kids, that borrowing capacity is a major, major issue.
Okay. So that's the other thing, the other caveat. But now let's assume we've got borrowing capacity to
Yes.
refinance.
Yep.
What can people do in this environment to get a better rate? Either with
Yeah.
their existing lender, or what should they look for with a new lender?
Yeah, great question. And the first thing I would say straight away is we always want to ensure that you're getting the base rate with your existing lender before we consider under other lenders as well, because we've had the banks are getting sneakier and sneakier that clients go to a mortgage broker and try and get them a better rate, but then a discharge team kicks in with the existing rate. to try and retain the business. And that's how you get the best rates. And then everyone's time's been wasted. So, but let me take a step back to clarify what I mean by that. So, in terms of getting the best rate. So, if you go, so the first thing I would say is compare the advertised rate with your current lender to new business and compare it to your current rate. Because what we're seeing is that gap is getting larger and larger and larger. So, for example, Bank XYZ might be offering 5%. Also, you've been with Bank XYZ for 2, 3 years. You look at your statement, it's showing at 6.5%. But then you go on their website and see, hang on, their interest rates actually for new customers actually 5%.
Mm.
All of a sudden, you've got a very good case to go to your bank and say, I want you're offering this new customers. I've been charged a higher rate. What's going on? We call that loyalty tax, and there's no loyalty when it comes to banks. You need to be looking around for your options. And I would suggest you need to be asking for a rate discount at least every 12 months. So, but there's a way that you do that, because if you go into your local branch and go, pretty please, can you give me a lower rate? The chances are the answer to that is going to be no. Um, you need to show that you're serious. And the way that you do that is obtain and submit what's known as a discharge form. So the discharge form is the form that you fill in to say that, yep, I'm serious about going to another bank, ABC Bank, for example. You put that on there. You look for a bank with a lower interest rate, or get a help. The mortgage broker can help you with this. You say, okay, ABC Bank's offering again 5%. You're charging me 6. That's why I'm leaving. All of a sudden, it's like magic, Rebecca. All of a sudden, the good rates come through because there's a team called the retention team that banks have that all of a sudden have a few bit extra magic powers that they can use to offer better rates. And yeah, where we've got so many examples of our clients on average probably get, it depends which bank, but usually about 0.5 to 0.75% discount on their home loan just by submitting their discharge form. The best example that I have is we had one client went into the bank, was told no, can't get a discount. Before we did 20 to 30 hours work of refinancing them, we submitted a discharge form for this bank. They got a discount on their home loan of 1.68%.
What?
And this is quite rare, they have got paid $3,000 into their bank account to stay with their current bank.
Right. And so that's typically the cashback that you get for refinancing to a new lender, right?
Correct.
So they've just honored what that person was threatening they would have got by going elsewhere. Is that what's happened?
That's pretty much it. Yeah. And now that cashback admittedly is is quite rare. I haven't seen many of those, but and that's definitely the best example. But like I said, usually if you haven't asked for a discount for 12 months, usually there's like we did another one with another bank. They've been there at their bank for 2.5 years. They got a 0.9% discount. Actually, we had one client I just sort of then. They've only been with their bank for 4 months, but noticed that their rate was higher than you business, and they got a 0.25% discount, which I thought was pretty impressive for only being with the bank for 4 months. So yeah, if you know, again, it just comes down to asking that right question, which is, and speaking to the right people, which is the retention team, is that where you can get that discount. And then I think crucially as well, going back to that example of the person who got the big discount at the cashback offer, check the T's and C's, but we've reviewed this particular client and there was no requirement for them to stay for a period of time. So you could get that better offer, get that cash back and refinance within a few weeks if you wanted to. So,
Right. So
yes.
a couple of questions. So
Yes.
was there any exceptional circumstances around the size of that loan? Like, was it a really big loan?
No, it was a 400 grand loan on
Right.
a property worth, I think, about 700,000. So there was a fair bit of equity, with that
Yeah.
definitely helped their case. But I think it was also the rate was ridiculously high as well. So that supported their cause as well. One thing I will add as well, I think it's really crucial you have, the fancy term is good account conduct, which means you're meeting your repayments. You've got a bit of a buffer there. And yeah, if you're doing those things by the bank will help you. We did have one client who only got a very tiny discount. We were quite surprised, but we asked a few more questions and realized, yeah, they had missed a couple of repayments. And as a result, the bank wasn't as keen to give them those bigger discounts. So that's certainly something to keep in mind as well. So in that situation, good low loan, healthy growth on the property, and very good account conduct means they're able to get a very good deal there.
So then let me ask you, if you've got a big loan, so let's
Yeah.
say you're around the $1 billion mark,
Yeah.
is that likely to is the bank less likely to give you a bigger discount just because of the size of the loan?
I haven't seen that in my experience. Uh, yeah, I haven't experienced that at all. That loan size is really a factor. If anything, a small loan is worse off. I mean,
Yeah.
400,000 is still a semi-reasonable
Well,
sized loan. I
yeah.
think we had one client who only had 150 and they didn't get much of a discount, but that's pretty standard. But usually, again, depends the rate you've got at the moment. But no, I don't think loan size is a real factor.
And in all of those cases, did those where they were successful in getting a reduction in their interest rate, um were they examples of where those individuals had shown they were serious using a discharge form or going through that process rather than
Yeah.
just calling and saying, "Can I have a discount?"
Yeah, yeah. No, look, one or two of those had called to get the discount. But we haven't had I can't recall a situation where we've had a client ask for, actually, there is one bank that didn't respond at all, which was very strange. So we just refinanced them anyway. But 9 times out of 10, if you submit that discharge form, someone's going to call you and get a better rate. So it's definitely not a foolproof process. But again, one phone call, 15 minutes, or submit a form, which takes another 15 minutes. It's certainly for a good, far better than even chance of getting a discount on your home loan. If you haven't asked one for 12 months, it's definitely a worthwhile exercise to go through.
And most of those, so when you said you've mentioned the base rate before,
Mm,
if there are there variations in the base rate depending on how much equity you've got in your property?
yeah,
So like not everyone who's looking online at their bank's advertised rates as the base rate is going to get the same base rate, right? If you've only just bought in the last 12 months, I'm assuming you would get a different rate than someone who's maybe had a mortgage for 5 years and got 30-40% equity.
correct. Yeah, absolutely. And you do have to look at those nuances. And particularly with the big four banks, it is very hard to get that information. So, um, yeah, that's definitely a consideration. That's yeah, the LVR, like you said, which is the loan to value ratio, i.e., how much is your loan in comparison to the value of your entire property, is definitely a big factor in these discussions. And if you've got a loan to value ratio above 80%, I mean, banks are going to realize pretty quickly, well, actually, you can't really refinance without paying lender's mortgage insurance again. So we kind of gotcha. They may not be as willing to come to the party. So that's definitely a consideration that comes into it.
So can you just touch on that point you just made? Because I think that's probably relevant to a lot of people
Mhm.
as well who have maybe got a mortgage in the last few years or
Yep.
recently, let's call it, and had paid lender's mortgage insurance. How does that interplay with this refinancing piece?
Yeah, great. Yeah,
Yeah.
great question. So, yeah, if you've purchased a property, say 2 years ago, and you either had less than a 20% deposit, and you either paid lender's mortgage insurance, or you've had a guarantor, or you use the first home loan deposit scheme, the 5% deposit scheme, which I'm a huge fan of. Um, if your property hasn't gone up significantly in value, and or you haven't paid down a lot of your home loan, which 99% of people haven't, in those 2 years, you're not going to pay down a lot on a 600 grand mortgage in 2 years.
Yeah.
Um, then if you were to move to another bank and you do not have the 20% deposit, then you're going to have to pay lender's mortgage insurance. Now, there is caveats to that rule. Some banks are less dependent on your occupation or their policy or things like that. So it's certainly not a hard and fast rule. But generally speaking, and particularly if you want the best rates that are available, you
Mhm.
do need that minimum 20% equity in your property, which means if your property is valued at $700,000, and you can go on to realestate.com.au to have a look. Use that as a guide, not possible, but certainly a good starting point. If your property, say, is $700,000, you need a 20% value of that is 140,000, which means your loan's got to be below 560,000 to be able to refinance with virtually any bank. If it's above that, your options may be limited and or you may have to pay lender's mortgage insurance, which most cases, if you've got to refinance and pay lender's mortgage insurance, it's not in your best interest to do so.
Yeah. 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 I mean, what we're talking about are people who have taken out a mortgage when rates would drop to near zero, essentially. Like,
Correct. Yeah.
you know, uh, and therefore they entered the property market earlier than, say, someone in the last couple of years when things had already sort of things really only started to move north again last year. But I think, yeah, I mean, the bulk of people who are facing this fixed rate mortgage cliff have sort of had a loan for around 3-ish years or more,
Mm.
and starting to roll off. So I think that's really useful because, yeah, most of the chatter online, the marketing, the news and press is all about finding the best rate, but it's such a nuanced area. And there's so many personal circumstances that are um, in the balance. The other thing that I read, which I think I'd love to get your thoughts on, Pete, you know, it was again an article talking about how easy it is to refinance and how to just get the best rate. But even if you are refinancing with your existing bank and making a significant contract change, like extending the term of the loan again to another 25 or 30-year term.
Mm.
Now, is that something people do? And what are the risks of doing that, I guess? Just
Yeah.
create a smaller, as I assume people do that as a way to reduce the mortgage repayment now,
Yep.
make it more affordable. But what are the risks of doing that? And is it something that's done? And if
Yeah.
yes,
Great.
really?
Great question. So yes, you are correct that in most circumstances, if you say, for example, got a loan 2 years ago, 30-year loan, you refinance today, your loan term is going to, it usually would extend for another 2 years. So it'll be a new 30-year term. So look, in my opinion, and maybe this is a little bit controversial, but I don't pay too much attention to that because at the end of the day, you're only going to be in your mortgage for 30 years if you continue to make the minimum repayments.
Mm.
And it's going to be one or two scenarios. It's going to be one, you need to make those minimum repayments because you've got a reduction in income or interest rates are high, but it's not going to be like that forever. And, you know, in the future, you certainly got to be thinking about, ways to increase your income, other investments that you can sell in the future to pay down that mortgage. It's not, or if you, for example, and we were speaking about this just before, like you're a young family, what one of the partners or yourself is down to a lower income just to help raise the kids. And then the kids are going to go to school and you're going to increase your work hours, continue your career, situations like that. When you're in that situation, you can make additional repayments to your mortgage and pay it down quickly. And again, a lot of situations, like we did one calculation for a client, if they paid an extra $50 a week on their fortnight, their loan term went from 30 to 20 years.
Yeah.
So that time frame is definitely a consideration if you're only, I should say it's only a consideration if you're making the minimum repayments. But also it's another factor as well when it comes to refinancing is if you're someone, for example, in their 50s, and you're trying to go to a bank for a 30-year loan term, the banks will scratch their head and go, hang on a second, is your plan that you're going to work to your 85, if you're 55, for example, to pay off this 30-year mortgage? There's not a lot of banks would be happy with that. So definitely not so much an issue in your 20s and 30s, but certainly if you're hitting 40s and 50s, getting that 30-year loan term is going to be a lot harder. So you could face a situation that, yeah, you might reduce your interest rate, for example, 1%. But if you go from a 30-year loan to a 20-year loan, your payments are still probably going to go up. your
Mm.
minimum repayments are probably going to go up. So again, it's not just about the rate. There's so many factors in the background that you've got to consider. And I think as well that even if you do reduce your interest rate, what are you going to do with the spare money? Because if you're just going to blow it on whatever over the long term, well, you're going to be in no better off financial position. Now, yes, okay. Now, if you use it either as a temporary thing, again, the family situation we just talked about, or you're going to use it to invest or make extra payments to your home loan, those sort of things, happy days, do it. That's all good. But if you just got this, and we see with some clients, they just spend any extra money that they've got. Well, doesn't matter what your interest rate is, you're just going to be worse off. So
Yeah.
there's quite a lot of things to consider there. And that's why I'm particularly speaking to a mortgage broker who can look at a few different banks and look at your situation as well. It's very important. I always say the rate is probably about the fifth or sixth thing that we look at. We look at things like serviceability, your borrowing capacity, redraw and offset accounts. Do you want fixed or variable interest rates? Are you someone that prefers internet banking or going to a branch? What's their turnaround time to process? Because just read that one bank is taking 2 months to just look at your application for the first time. We look at all those things before we even talk about the interest rate. So they're all what are the repayments are as well. There's so many things to consider. It can't just be about the interest rate, and that's where talking through understand your situation is so crucial. And having someone who can look at different policies, different lenders, it's just so crucial to ensure you're getting the best deal, not the best interest rate, but the best deal for your situation.
Yeah. Yeah. And let's talk about some of those things you just mentioned. What are the most important things we look at in terms of, refinancing? And it's not just necessarily the interest rate. I mean,
Yep.
that's if we're talking about someone who's looking to refinance because rates are rising and affordability is a concern, then for them, rate is important because that's got a direct
Mm.
relationship to how much they pay. I think the other thing that people always seem to look for, because it's often spoken about as, a must have or, something that's very useful is a offset account.
Mm.
What's your thoughts? And of course that's true in certain circumstances, but what's your thought on its importance in this example that we're talking about? Because, I mean, if we're looking at refinancing, interest rates rising, affordability is a concern,
Yeah.
if there's not a lot of surplus cash flow, there's unlikely to be a lot of savings there to necessarily warrant the offset. What are your thoughts on the priority of that in this scenario?
Yeah, great question. And there's quite a few nuances and on that question, and there's quite a few technicalities as well. The difference
Sorry.
between offsets and redraw and things like that. So, for sake of time, let's keep this to a couple of minutes. But look, you are absolutely right that an offset account is usually going to attract either a higher interest rate or a package fee, two, three, four, $500 a year. So an offset account can be more expensive. Um, Whereas usually you can get what's known as a redraw, which works similar to an offset account, but there are some differences, especially from a ownership perspective, but also particularly if you've got an investment property or plans to convert to investment property perspective, there are some nuances there that you need to
Mhm.
consider. But you are correct that if you don't have a lot of savings and don't anticipate making big lump sum payoffs in the future, yeah, an offset account may not be the right option for you. So, um, yeah, it's definitely not a hard and fast rule. You must need an offset account. That's definitely not true. Uh, there is, it really depends on your situation, and yeah, for some people, a basic vanilla low interest rate home loan is the best thing for them. But on the flip side, there are other people who've just got a basic low interest rate home loan, and that's not the best thing for them. They've got either high savings or more complicated needs, um, and they would be better off going with another provider that does have a bit more flexibility in policy or product or whatever it might be. Yes, that might cost them more, but it gives them the flexibility to do a few other things, some of their other goals, whether it's investing, renovating, whatever it might be. So yeah, there is no hard and fast rule as to what the best option, best bank is for everyone.
Yeah.
It really is a personal situation. And that's why, again, you need to speak to someone who knows all the options to see what is the best option for you.
That's right. That's why they call it personal finance. Um,
Exactly.
so, okay, let's jump to someone wants to refinance, needs to refinance, is looking into it right now. What do they need to do to their personal finances on a day-to-day money management kind of thing to, prepare and put their best foot forward as part of that application?
Yeah, great question. So, I always, I always say the number one thing, if people are looking for what's your best bit of financial advice, I'm always a big believer that look for anything that you can do to increase your income. We talk about reducing expenses, and yes, that is important, and cutting things out like particularly afterpay credit cards. Those, if you can get rid of your help debts, those things do have a significant impact on your borrowing capacity, any subscriptions, that sort of things. But at the end of the day, if there's anything that you can do to increase your income, whether it's at your current job or a new job, self-employed, side hustle, whatever it might be, selling something, anything you can do to increase your income is in my opinion, the best financial decision that you can make. And we've got uh, plenty of just plenty of examples with clients that I can think of. One, I knew straight away from their salary that they're underpaid for what they did. They're on $65,000. I told them to shop around. Within 6 months, they got a job at $90,000. So incomes. What higher income does, it's a multiple impacts. It increases your ability to meet your current home loan. It makes you more likely to get a better interest rate on your home loan because they can see what, if you assume your pay goes in the same bank, they can see what your net pay is and they can calculate, well, how much is your income? All right, you've got a high income. Happy days. We want to keep you around. Higher income also means your borrowing capacity increases because at the end of the day, the higher your income, the more you can borrow. So, which might navigate that up, which gives you more options to refinance to potentially to other banks. So, yeah, expenses are important. I'm not downplaying the importance of that. And I know in a lot of situations, particularly single parents, young family situations, increasing income is not an option because you just don't have the time to do it. So, yeah, cutting down expenses is important. But if there's any way that you can look at increasing your income, asking for a pay rise, looking for a role that's higher paying, similar field, similar experience to what you're doing at the moment, um, you take that opportunity because that impacts not only your ability to refinance, but obviously higher income, assuming you're self-employed means you're going to have more super in retirement. It's going to mean more holidays, better access to care, so many benefits of doing that. And I think for a lot of people, if they spend more time focusing on ways to increase their income rather than reducing their expenses, they'll be far better off in the long term.
Yeah, absolutely. Some great advice there. So increasing your income or looking for ways to do it, even marginally. It's great if you can, double your income or get a quite sizable increase, but starting small and anywhere is the first step. You mentioned some of those things that help to increase your borrowing power by reducing some of the, let's call it debt and or credit infrastructure that you have.
Yep.
So those you mentioned briefly, HEX debt,
Yep.
credit cards, and buy now, pay
Afterpay.
later. So
Yeah.
I think people understand. Well, we've done some webinars recently on HEX and how that impacts your borrowing capacity and what to consider there. I don't think some people understand how why a credit card influences your borrowing capacity, especially where there's a zero balance on it.
Yeah.
So can you explain that to people just so that they can understand? They've got a $30,000 credit card limit sitting in their top drawer just in case. How
Yep.
that's, why that's an issue potentially.
Yeah. The short answer is because virtually every bank in Australia, if you've got a credit card, will work on the assumption that your credit card is maxed out. Because you can, if you've got a 30 grand limit, you can max out your 30 grand limit. Even if it's zero, Doesn't matter what's on there. It matters what the limit is. So, and we've had another client we're working on right now that was a bit short with borrowing capacity. They had a $20,000 credit card limit. We advised them, look, if you could reduce this down to even $5,000, I think it increased their borrowing capacity by about $40,000. So, and then ideally, if you can get rid of it completely, that's even better. But yeah, the bank will always assume that your interest rate, that your credit card is maxed out.
Yeah.
So that's why if you can reduce your limit or get rid of it completely, that's the ideal scenario if borrowing capacity is an issue for you.
Then buy now, pay later. How do they look at buy now, pay later debts?
Again, varies from bank to bank, but ultimately they just say get rid of them.
Yeah.
They just, they rarely ever they will generally make it a condition of the loan, that you need to get rid of it.
Okay.
They're pretty, brutal, when it comes to buy now, pay later. And it's just not worth the stuffing around, to be honest. I would just close it down, keep the exit letter. That's really important because your credit file might say that you've got it, but it may not have it been updated that you've closed it down. So definitely keep the exit letter that that you have closed down this account and give that to your mortgage broker because they probably will need it. But yeah, I just say if you're looking to refinance, just get those little debts, particularly Afterpay, just pay them off, close them down, get rid of them before you go through the refinance process. It's far more hassle than what it's worth.
And how big of an impact with the changes to credit reporting, where positives, proactive sort of credit management activities on your part, so paying things on time or paying things, in advance. How influential is that or beneficial is that in terms of refinancing? So if you're someone who's had a mortgage for a couple of years and you've been making additional payments consistently and they can see that, is that something that they take into consideration from this rate perspective?
Not, not
Not
as big as you would think. I guess it depends. Again, depends what the bank looks at and weighs more. And again, varies from bank to bank because some banks would look at just your credit file, and your credit file doesn't show if you're making additional repayments. It just shows have you got the facility? Is it still open? And are you making your minimum repayments? So if you're just making your minimum payments or putting in an extra $1,000 a fortnight, your credit report's not really going to show that. But if the bank takes a closer look at your statements, your loan statements, some do, some don't. Really depends on the bank. And if one shows that you're just making the minimum repayments, the other one's saying you're making extra repayments, it could definitely be an impact there. But look, at the end of the day, as long as you're meeting your minimum repayments and have done for your credit report's usually shows the last 2 years of repayments. As long as you've done that, then you're okay. If you've missed one, it's may not be the end of the world. Banks have a little bit of grace, but it's if you've missed a few, that's when your credit score will be significantly impacted, and you might have to look at other options to get credit, which likely will mean a higher interest rate.
So just finally, what happens if you've gone through the motions and you just can't refinance right now? Whether it's a borrowing, you're in a negative equity situation, maybe you're in that mortgage prison you described. What do you do? Like, what is the next best step?
Yeah, great question. And again, it really depends on your situation, whether it is, if you haven't got a good discount from your current provider or you can't look at refinancing to another bank. I think the thing I would say is it's not a hard no, it's a not yet.
Mm.
And so probably the worst thing you can do is actually keep trying and keep making credit inquiries. That's going to go on your credit report, which will have a detrimental impact um, your credit report. So a broker should be doing, it's not foolproof, but they should be doing most of the work. And before you submit your application, and if they go, I've got some concerns here, I'm not sure if you should submit, they should withdraw. They shouldn't even submit the application at that point in time. So because submitting it and getting a fail may have a detrimental impact on your credit report. One's okay, it's multiple, it's where it's concerned. So, but going back to the question, like I said, it's not a no, it's a not yet. And if we fast forward 6 to 12 months' time where interest rates hopefully have come down, the value of your property has gone up, your income has increased because you've got to pay for us at work, there could be a policy change with lending either at government level or bank level very quickly. Banks always assume a 3% buffer when it comes to your home loan at the moment. If that, for example, gets reduced down to a 2% buffer, then that increases your borrowing capacity, which may mean be able to refinance. There's been one bank that's recently changed for nurses, where usually you needed a 20% deposit to refinance or purchase. Now they're offering to nurses with a 10% deposit as well. There's so many things that change.
Mm.
So it's probably just a case of, look, let's revisit this in 6 months. Focus on what you need to do. Maybe it's account conduct's another one as well I didn't mention, but take a breath, focus on increasing your income, reducing your expenses like we discussed before, and revisit it in 6 to 12 months. Don't try and apply for different banks every 6 months. It's probably the worst thing you can do. Focus on, yeah, what you can control, income, expenses, get through the next 6 months. And it could be some things that are outside of your control, which move in your favor. And then that opens some opportunities
That's a great answer. That's the best one I've heard so far. So,
for you.
so thanks, Chris. I really appreciate your time, and everybody here at Money Happy does as well. Thank you for sharing on refinancing in a rising interest rate environment.
Thank you very much, Rebecca, for the opportunity and for the great work that you do at Money Happy. It's really making a difference. And I'm sure we'll speak again very soon.
Thanks, Chris.